Hi there, and welcome to this fourth lecture for Banking Risk 2. In this lecture, we're going to cover the interest rate risk regulations and management to conclude theme 1. By the end of these recordings, we're going to cover the various trade-offs between regulators, banks and shareholders when it comes to managing and regulating interest rates. We're going to look at the various scenarios for the bank's income and balance sheet and value if interest rates go up and down depending on the various gaps they may have in the models we've covered so far in this module. We will then look at how a bank could use interest rate swaps to immunize its balance sheet, and then we'll finish off by discussing the role of the Asset and Liability Management Committee within a bank. So first of all, watch this YouTube video to show an analogy of the trade-off we're going to discuss. Okay, so you've just watched the gunfight at OK Corral, and this was one of the most famous US Wild Western gunfights to take place, and this took place on the 26th of October 1881. And like any typical Western film, it portrays good versus evil. In this case, the lawmen were the good and the cowboys were the bad. Very typical for a Western film. But now ask yourself, were the lawmen really fighting the greater fight? Were they doing this for the good? Think about the cowboys. They were accused, but were they prosecuted by law, or did the lawmen take actions into their own hands? The lawmen themselves, were they not the bad guys here? Because they didn't follow a traditional legal process that we know of today. So how does this relate to finance? Well, to keep this going, we can say the lawmen, if we come from a UK point of view, we have the three various regulators, we have the Financial Policy Committee, whose main role is part of the Bank of England to reduce systemic risk across the banking sector. We have the Prudential Regulatory Authority, they're the people that regulate the banks. They authorise them to trade, and they also look after the safe and soundness of the system. And they're obviously interested in the capital requirements for the banks. And we also have the Financial Conduct Authority, and their role is really to protect consumers and consumer rights relating to financial products, and to authorise the conduct of individuals within the banking sector. And the cowboys, well, obviously they're meant to be the banks in this example. And these are the banks that work in, obviously, the confines of law, but they also work in the confines of modern day technology advances, and quite a lot of, certainly, technology advances that outstrip regulation. And what we've seen, certainly during the financial crisis, is that they operated in a way where they created very unique and sophisticated products that potentially the banks or the regulators didn't understand themselves due to financial innovation. So let's consider this gunfight. It was a bit of a lawless scenario. Is the banking territory really lawless? Is the banking sector open to abuse? We have the three types of regulators here. Are they really required? Can the industry not self-regulate? If they can't, how much intervention should the regulators have? Should they have a light touch? Should they be more principles-based, spirit of the law, or rules-based, letter of the law? Are the bankers really cowboys? But obviously in this analogy there was lots of bystanders. The lawman walked past lots of bystanders. Who are they? In this case, it's the shareholders. What do the shareholders want out of all of this? So think of the cowboys. Obviously the managers within the bank. What do they want? Of course, they want the best. But what does that even mean? Large profits? Do they want to take large risk-adjusted profits? Do they want to ensure safety as well as making profits? Or do they want to make what's classed as a socially acceptable profit? But what does that even mean? Do they want to be efficient? Think about in a bank, how do you become efficient? Effectively, you're transforming your inputs to outputs to make the most out of customer deposits when you're potentially lending out. But what other potential inputs are there? There's borrowing from the markets and then potentially lending again out to customers. So how efficiently do you do this, and at what cost? But we have to remember, what's the purpose in the banks in a capitalist society? Going back to lecture 1, it's for them to create wealth. Therefore the regulators want them to create wealth, but they also want them to do it safely. Think about who actually own the banks, the shareholders, the bystanders and all this. What do they want? Of course, they want capital gains and potential dividends, thus they want the banks to be profitable. They obviously want them to be safe so that they do get capital gains. But if you actually look at who owns the banks, so if you go on to like Bloomberg, go on the own function and look at the list of who owns the equity in the banks, well, it turns out it's the banks that own the banks. So quite a lot of the major shareholders of banks are the neighbours, they're competitors. So there is an industry self-interest for the banks to perform well together, given that they all own each other, and that if one went down, it would impact the risk of the other. Thus, how do the regulators take into account that we need the banks to create wealth, but we want the banks to conduct in a safe manner, we want them to be safe, we want them to be there for our customers, but going to the risk-reward trade-off, the banks have to take some level of risk to get some sort of reward to generate wealth within the economy. So obviously, in the likes of the UK and obviously at BIS level, there's a number of factors that they bestow on banks to follow. So the BIS, from obviously your banking risk 1 days, we talk about minimal capital requirements, the supervisory requirement, and the market discipline and disclosure requirements. I mentioned the 3 providers in the UK here. And it's obviously the UK regulator's role to legislate the recommendations by the BIS. And the main way of ensuring the safeness and soundness of individual banks, as you would have covered in the likes of Banking Risk 1, is the function of capital. The fact that the banks have to hold a certain amount of capital, Tier 1 equity, to fall back on in the event of unexpected loss, and to ensure that the banks have enough capital in case there is high levels of uncertainty, and uncertainty, as you know, can't be measured. Obviously, you can have a look at the various Basel III requirements for how much capital is actually required. In the assessment for this module, you're required to look at the cities, and they also need an additional level of capital on top of that to take into account that they're globally systemically important. But obviously, historically, if we look at the likes of default rates, certainly for investment grade products, they're typically very low. But obviously, during the financial crisis, this really spiked up relatively. So is having an excess amount of capital actually needed? But obviously, so far, I've only mentioned capital from the default point of view. Think about the things I've already talked about in the previous lectures. The fact that if interest rates go up, then this can potentially lower the ownership equity, the Tier 1 capital, if you have the likes of a positive duration gap, which is very typical in a bank's balance sheet. So the role and function of capital is not just for default, it's also taking into account that the balance sheet can shrink due to the likes of interest rate change. So the capital requirements is obviously Pillar 1 of Basel Accords. Pillar 2 is all about the supervisory element of capital to ensure that the banks do address both on-balance sheet and off-balance sheet via the methods of calculations that we've already discussed. So in this case, using the duration model to assess how the balance sheet reacts to interest rate change, this sort of measurement technique would fall under Pillar 2. As well as this pillar on the measurement front, it obviously provides incentives for certain long-term improvements to risk appetite and managing the risk-reward trade-off moving forward. And then the last pillar, Pillar 3, is really about the market discipline of the participants, but really from a disclosure point of view. What do the banks disclose and what do they not disclose? When we talked about the measurement techniques that are required, banks need to disclose how they potentially measure and manage the likes of interest rate risk. And any sort of model they do use, it must be transparent, consistent, relatively easy to understand, not a black box scenario. So if we summarise this battlefield, it looks something like this. We have the 3 pillars of the Basel Accords, and under Pillar 2 we have these 3 models: the repricing model, looks specifically at the income statement. The maturity and duration model really looks at the overall balance sheet and the current financial position of the bank. The bank managers have to obviously manage the outcomes of these models in a way that makes the bank profitable, but also for a given level of risk. And the given level of risk is therefore to satisfy shareholders to ensure that, one, their equity capital doesn't reduce if interest rates change, but also when they issue loans relative to customer deposits, make sure the funding gap is profitable. So the bank managers have to take into account their own needs, the shareholders' needs, as well as ensuring they meet all the regulatory requirements, obviously set originally in the Basel Accords and implemented in legislation by the individual countries' legal process. But this battlefield, this is just one bank. The same battlefield is in the next bank, and the next bank, and the one after that. And they're all connected to each other because they trade with one another. They have derivatives portfolios against each other. They have loan counterparties with each other. Some over the counter, some via a market. I mentioned earlier on the shareholders. Well, the shareholder of this bank might be also the shareholder of the other bank. So they all technically own each other. But the ultimate objective for the financial system, going back to lecture 1, is to allocate resources efficiently and to generate wealth for the society. So the question is, how do you do this in a safe and sound manner? Do we need this much regulation, or can they regulate themselves? When it comes to interest rates, the main document regarding the principles of interest rate risk management is the Interest Rate Risk in the Banking Book 2016. Now this document revised the principles of 2004, and this 2016 document is now being adopted and integrated within the full Basel Accords. As part of these interest rate risk management principles, there are 9 in total that are specific to the bank, with a further 3 that are aimed at the supervisory element. And the full detail of these 12 principles can be found in the document. But the idea is it's not a list. It's meant to be a process, a cycle, a continuous cycle. So something like this that outlines the 9 principles that are required from a bank's perspective. As I said, the further 3 are from a supervisory point of view. So obviously the first one being that the bank must identify and have appropriate measurement and controls in place for the likes of interest rate risk. And then as you go through the cycle, it's really about having a process, understanding the process, understanding the impact on your bank, what systems do you have in place to manage the impacts on your bank, do you have enough capital in the event of stress testing within your bank, and the cycle starts again. And within the bank's balance sheet or annual report, or the Pillar 3 disclosure report, you can potentially assess whether your bank actually complies with the first 9 principles of interest rate risk management. And you can see from this example from Barclays in 2018, when reviewing their annual report and so on, we can potentially assess whether the bank actually met the 9 principles. And where they potentially do not disclose this information, we can potentially assume that they haven't potentially met this requirement. But obviously this here is done on a rather subjective base, and the notes kind of highlight where potentially you may find this information. So this would be potentially a good exercise for you to do when you pick your globally systemically important institution to work on for your assignment. And this concludes part 1 of this lecture.
Hi there, and welcome to the second part of this lecture for interest rate risk management. In this part, we're going to look at how you should interpret the gaps and the signage on the various interest rate risk models and see how we should interpret them given an expectation of interest rate changes. In this, we're going to look at the gaps relating to the repricing model, the maturity model, and the duration model in turn. Now, if you remember, the repricing model is all about cash flow, specifically cash flow on variable interest rate products. The maturity model is all about economic value, and duration is the preferred method by the BIS, which takes into account both economic value and cash flow timing. So all these examples are going to be discussing the signage of the gap on the models if interest rates are to rise. So always remember it's about interest rates going up in these examples. So first of all, we'll go back to lecture 2 and look at the positive funding gap. A positive funding gap, also known as potential reinvestment risk. A positive funding gap tends to be the most profitable sort of gap for the bank. Essentially, they have more coming in than they have going out. Typically, assets in a bank tend to have a higher interest rate than the liabilities. If you think logically, as a customer, you'll always pay more on a loan than you'll get on your customer deposit. So this is very typical. So, if you have a positive funding gap and interest rates are to rise, well, this of course is going to be a good thing for net interest income and overall profitability, as your variable products interest rates will change, but typically, because your assets are more longer term than the liabilities, then the yield curve doesn't shift in parallel, it tends to tilt, such as this diagram, and certainly tends to tilt up more at the longer end than the shorter end. Therefore, the interest income on your assets, which are longer dated, will probably rise further than your liabilities will. Therefore, it probably improves net interest income even further. And again, if you think as a customer, if interest rates change, say if interest rates go up, as a depositor, your deposit rate probably won't go up as much, but if you have a loan, certainly a tracker, it'll probably go up instantly. And going back to the battleground scenario, obviously as a manager in the bank and a shareholder, you want to take advantage of interest rates rising to become more profitable. If we look at the opposite scenario, so again, interest rates are still going up, but if we have a negative funding gap, so this is where we have more variable liabilities going out than we have coming in. Now remember, this is all about variable products, rate-sensitive products. So if you do have a negative funding gap, the likelihood is there'll be a positive gap on the fixed assets and the fixed liability side. So typically, if you have a negative funding gap for the repricing model, this may be because the balance sheet has more fixed income products on it than variable. So obviously for this we ignore the fact that the fixed products exist. But potentially on the variable side, because you have more going out than you have coming in on the balance sheet, then obviously this is a concept of reinvestment risk. But also you think, if you've got to pay out more than you have coming in, there's obviously an element of opportunity cost there. Why don't you have more assets on the balance sheet to get more money coming in? But if interest rates were to rise in this scenario, similar before, the income on your assets would improve, which would potentially help you here, but your liabilities would increase only by a little. So a negative funding gap, if interest rates went up, it would still benefit you because your income from assets would go up, but as long as you don't put up the rates you pay out on the variable liabilities. And again, typically, if interest rates go up, liabilities, you probably wouldn't put up how much you pay on customer deposits up too much, but you'd certainly charge the assets further. So a negative funding gap isn't the best situation to be in the first place, but if interest rates do go up, then your asset income will improve further than your liability income. And again, this is highlighted in the fact that the yield curve rather tilts than it actually moves in parallel. But the obvious management situation in this case would either be to make your gap less negative or start to make it more positive to be more profitable, unless your balance sheet is set up that you have more fixed products than variable products, which are not taken into account in this model. Okay, let's move on to the maturity model. Now, this is the case of a positive maturity model gap. Now, this is typical for a bank. Most balance sheets are set up to have longer dated assets than liabilities. Remember, this model does not take into effect any cash flows. It's all about the size and the length of the products. But yes, typically an old-fashioned balance sheet would have much longer dated assets than liabilities. And this is what really needs to be managed, because if we remember back to lecture 2, when we said interest rates go up, then longer dated products, their prices tend to move more, and that was one of the rules we covered. So in this case, if interest rates go up, then the drop in the asset values is further than the drop in the liability values, and that would mean that the equity capital would shrink. And obviously, from a regulatory point of view, we don't want to see any shrink in regulatory capital. So from the bank management point of view, because this is the typical scenario for a bank's balance sheet, they need to potentially manage the size of the gap, because if interest rates are to go up and you have a very large positive gap, this is going to hurt your balance sheet more if it's a positive but smaller gap. On the flip side, if you have a negative maturity model, where you have more liabilities than assets, then again, if interest rates go up, your assets will still shrink, but your liabilities, which you have more of, will also shrink. And they may shrink further than your assets will shrink because you have more of them. Thus, if liabilities shrink more than the assets shrink, then technically the ownership equity might slightly grow to plug the gap of the shrink in the liabilities. But the more likely outcome is that your assets will definitely shrink, your liabilities will still shrink, and ownership equity might only just shrink a little bit. And this ultimately depends on the level of leverage on the balance sheet and the actual size of assets relative to liabilities. But essentially, for a negative maturity model, if interest rates go up, equity probably will be impacted, but not be impacted as much in the case of a positive gap. If you go to the duration model, quite frankly, it's very similar. Obviously, the duration model takes into account both timing of cash flow and the economic value of the products. If you remember, when we did the duration gap, this was time in years, but then we did modified duration to correct this to take into account price sensitivity, and it's the modified duration we're interested in and the gap on the modified duration. So very similar to the maturity model, typically a bank's balance sheet will have a positive duration gap in that you'll have longer dated assets than liabilities, even taking into account all the cash flows. Now obviously previous examples, we did use fixed income products, but it is worth mentioning that you of course can do duration on variable products, except from you have to assume that interest rates may remain the same and forecast the cash flow payments on that basis. So if there is a shift in interest rates, then the cash flows will obviously be impacted as well, which would ultimately change duration. And similar to the repricing model, longer dated assets tend to have higher cash flows than shorter dated liabilities. So an increase in interest rates will differ the duration on assets and liabilities rather differently because of this. But like the same as the maturity model, if interest rates go up, then the duration assets will shrink more than duration on liabilities. Therefore, equity capital will also be squeezed. So similar, from a management point of view, the banks have to potentially manage this positive gap. If interest rates are likely to go up, then you obviously want a positive gap because that's how a bank's balance sheet works, but you want to make sure the gap isn't too big. On the flip side, if you have a negative duration model gap, then again, similar to the maturity model, your assets will shrink, but they won't shrink as much as the amount of liabilities will shrink. So equity capital will probably shrink a little bit, but not as much. And in the case if it's very negative, then potentially if assets drop further than liabilities drop, then technically the ownership equity could potentially slightly grow in size, having a positive impact on regulatory capital. But that ultimately depends on the size of the negative gap if interest rates are to go up. So essentially, from interest rates going up, the best possible scenario for a bank would be to have a positive funding gap, a negative maturity gap, and a negative duration gap. But quite frankly, is this possible, given the nature of a bank's balance sheet and in the fact that the banks take in short-term deposits or loans and lend out long? Therefore, it's highly unlikely for banks to have negative maturity and duration gaps. So typically, from a bank's balance sheet, we typically have a positive funding gap because that's the most profitable, but we also have positive maturity and duration gaps. And as we know, if interest rates go up, then with negative maturity and duration gaps, this impacts regulatory capital. Therefore, this is what really needs to be managed. How big is this gap? If you expect interest rates to go up, you probably don't want your duration gap to be too large because it will shrink your assets much more than liabilities and really hurt regulatory capital. In the next part of the lecture, we will explain how you might potentially do a macro hedge to offset this shrinkage in the balance sheet. The remainder of this element covers if interest rates were to fall and go through the various gap scenarios. There's a clue here, it's quite the opposite, and of course you can read through this in your own time to get a better understanding if needs be, but it's literally the reverse of everything I've just said. So if interest rates were to drop, then the most ideal scenario for the bank would be to have a negative funding gap, but a positive maturity and duration gap. Now, of course, most banks do have a positive maturity and duration gap. Therefore, they will benefit if interest rates were to go down, because that would grow regulatory capital. But typically, banks don't have a negative funding gap. They typically have a positive one, ignoring that fixed income products exist, obviously, because a positive funding gap is a more profitable scenario. So potentially when interest rates are dropping, banks will naturally benefit from the positive maturity and duration gap. However, we also need to consider that when interest rates drop economically, they're dropping for a reason, and any fall in interest rate is likely to have a bigger consequence on price, on economic value, than if interest rates were to rise. And again, that was one of the rules we mentioned in Lecture 2 regarding the maturity model. If interest rates are dropping, then economic value is going to swing more than if interest rates were going up. And that's really due to market sentiment and how prices potentially react in real life. And this concludes this part of the lecture.
Hi there, and welcome to the third part of this lecture on interest rate risk management for Banking Risk 2. In this lecture, we're going to look at a way the bank may hedge its exposure to interest rate changes. But first of all, in the management process, managers have to adhere to the first principle of interest rate risk management set out by Basel, and that is to set the risk appetite for interest rates and have policies in place to potentially deal with interest rate change. But before we can actually manage interest rates, we really need to start with taking a position. So we've already established a risk appetite, but the first point of call is looking at potential future interest rates, assessing what the interest rate is right now, but then thinking, well, where's interest rates to go? Are they going to rise? Are they going to fall? And potentially at what pace and when? Now, obviously, it's not an easy task to forecast interest rate. In Lecture 1, we looked at the likes of the yield curve, and we potentially assessed a predictability of interest rate changes moving forward. And the idea is that, if you believe expectation theory, that longer dated interest rates follow the path of short-term interest rate, and that determines the slope of the curve. So with a positive yield curve, then that suggests over time interest rates will rise. But obviously we'll have to look at other macroeconomic factors, potentially market sentiment, and other economic indicators to assess where we believe interest rates may go. And as well as that, we also need to look within. How complex is our balance sheet? Is our balance sheet full of fixed products? Is it full of floating products? Is it a wild mixture? So these things really need to be taken into account before we even start potentially looking at hedging. There's potential other things that we need to consider, the likes of off-balance sheet items. Do they have an impact on the bank's level of risk and profitability? We also need to consider the likelihood of credit risk. On any of our loans, for instance, all of our forecasting with the certain models may be interrupted if credit risk spikes. But as well as that, one of the sources of interest rate risk is optionality, and customers can pay back early. So again, that builds into the additional complexity when we've created the measurements and we've used the measurement techniques, but then when we look at the complexity of our balance sheet. And the first point of call when we're looking to hedge interest rate risk is most likely the use of derivative instruments. So we need to assess the potential implications of derivatives. Ultimately, from a risk management point of view, derivatives are used for hedging. But there is, of course, a whole speculation side to derivatives transactions. But we're really looking at this from a hedging point of view. And why may you want to hedge? Well, obviously, we're trying to minimize risk. The example we're going to go on to do is where we see a positive duration gap, interest rates go up, the balance sheet drops, just like we finished off lecture 3 with. We're going to potentially look at how we can use a swap to hedge this exposure to equity falling to potentially offset that using a swap. And that is obviously of use to shareholders and regulators who don't want to see a drop in equity capital. They want to make sure that this exposure is hedged. But not only at the full balance sheet level, we need to think if interest rates are low, then obviously the bank, when they issue products and they potentially want to lock in potential future rates, they're likely to want to get fixed derivatives and secure low rates for a while. So when interest rates are low, banks are more likely to lock into low rates, certainly on the liability side of their balance sheet, to ensure that a fixed low interest rate is only paid out moving forward. On the flip side, if we believe interest rates are going to fall, then of course the management are probably wanting to lock in at the higher rate so that when interest rates do fall, they take advantage of having a fixed rate at the higher interest rate. So potentially on the asset side, fixing longer when interest rates are higher. But also if we think about when interest rates drop, then overall market sentiment is lower and the value of assets and liability are lower, and also derivative contract values also reflect market sentiment. So potentially, as mentioned earlier, when interest rates are dropping, prices get depressed more when interest rates go to rise. But also if you think about when interest rates are falling, customers are potentially going to look for the more variable products that would be our nature to do so. So potentially the marketing or the issuing of new products within the bank have to still be competitive to attract customers, but at the same time, the bank doesn't want to leave itself exposed to reduced income, certainly if we look at the repricing model. But remember, whenever we use derivatives, this is because we've made an assessment of what might happen in the future. We've took a position where we believe interest rates to go. And quite frankly, if we get that wrong, that could be quite costly. This could impact our profitability and capital even further. Or if we're able to unwind the derivative, so cease the contract, depending on whatever derivative we've used, the unwinding costs could also be expensive. It is worth noting, if you look at a bank's balance sheet and you look at their derivative transactions for hedging purposes, if they've actually made a gain from hedging, they won't call that profit. They're likely to call it something like hedging inefficiencies, because the idea is they want to be hedging, not speculating. They don't want to make excess profit from the hedging book, so it's classed as hedging inefficiencies. And that again is down to risk appetite. So how might you use derivatives on your balance sheet? Now when we did the duration model, we potentially looked at having an immunized balance sheet where the assets and liabilities, the gap was zero. Now in practicalities, this doesn't really happen. As we mentioned numerous times, assets are dated longer than liabilities. And that's how a typical balance sheet is set up. So how do you potentially hedge the exposure? Now do we do it at a micro level? So we potentially match assets with liabilities. So pretty much match every 10-year asset with a 10-year liability. Now is that even feasible? Can you even do that? Do you potentially put derivative contracts in place instead if you can't offset individual product? So do lots of derivatives for hedging individual assets or liabilities. Obviously when we're using derivatives there is transaction costs in place, and again you're still taking a position which could go wrong if interest rates change in the direction you were not expecting. So micro hedging would take a lot of effort, certainly from the Treasury Department of the bank, to do. It's more likely for them to do micro hedging on potential certain assets, and that would be of a certain size potentially. Or we could look to do a macro hedge, and this would look at the holistic portfolio, the whole balance sheet, and potentially produce a overall hedge to ensure that we maintain our equity capital if interest rates were to change. But obviously looking at a macro hedge, this is really a difficult task because first of all, a balance sheet is not very stable. It's very dynamic. They're complex. Products end and start all the time. The balance sheet is just a snapshot, a picture at one point in time. So if we're going to do a macro hedge, we need to think about when do we take a picture of the balance sheet? How long is this hedge going to be? At which maturity bucket? Remember back to lecture 2 where we talked about the repricing model and the different buckets, all 19 maturity buckets that the BIS recommended. Which one of them do you use to potentially hedge? Do we hedge the whole balance sheet over the 10-year horizon, or do we do it over a 1-year horizon? And then obviously depending on the size of the balance sheet, we need to work out what potential derivative we're going to use and potentially the costs involved of entering the derivative transaction. Let's use the example, and we're going to follow on from the end of lecture 3. So if you remember back then, we looked at a duration gap where we simulated if interest rates went up, the value of the balance sheet dropped by 2.09. So interest rates went up by 1%, the balance sheet dropped, which shrank regulatory capital, ownership equity. Essentially, what we're going to do here is we're going to enter into a swap contract which will potentially offset this fall in regulatory capital. In other words, the balance sheet goes down in value, but our swap goes up in value to kind of plug the gap. So in order to do this, we're going to enter into a vanilla swap. And this is a fixed for floating swap. This swap transaction means that we're going to accept a fixed rate on a 10-year bond, and we're going to pay out a floating rate on LIBOR for a year. So our asset is 10 years, our liability is 1 year. Asset fixed, liability floating. Now you're probably thinking here, well, if interest rates go up, then we're conceding floating rate and our asset's fixed, so our asset is going to pay the same, but we're going to pay out more on the LIBOR 1-year product because interest rates are going up. Well, that is true from a cash flow point of view, but remember, we're talking about the value of the swap, so the overall economic value of the swap. We're not too interested about the cash flow because we're using the duration model, which takes into account simulated cash flow, but also the timing of the payments and the overall duration of the product. So in order to work out the economic value of the swap transaction and how much the likelihood of the economic value of the swap changing if interest rates change, we need to convert the swap into the duration of the swap. So similar to the balance sheet, we have the duration of the asset side minus the duration of the liability side. Of course, this is a 10-year bond minus a 1-year floating product. So you're probably thinking the duration is simply 9. However, we'll cover this a bit later on, but obviously we're accepting a 10-year bond. Now, I haven't suggested what the coupon on this bond is, but obviously a bond pays a coupon semi-annually. Therefore, it might be a 10-year maturity, but taking into account the cash flows, the duration of the swap is actually 7 years in this example. So if we look at the likes of, first of all, the gap, and then when we need to do price sensitivity, remember we need to use modified duration. So we do the modified duration of the swap, and the formula can be expressed as below. So on the left-hand side, we have the duration. In the middle, we times this by the size of the contract. And then on the right-hand side is the percentage change. So we're simulating if interest rates are changed, what does that do to the value of the duration gap times by the size of the actual contracts we have. So as I mentioned before, The purpose of us actually doing this is we're entering this swap, and now this swap is off balance sheet. So we've got the size of the balance sheet on one hand, but we want to do this swap in our trading book, which is off balance sheet because we're hedging the whole balance sheet. So this can't be on the balance sheet. We're essentially saying if interest rates change, we need to see the change in the equity on the balance sheet and then do the opposite for the value of the swap. So we're suggesting from lecture 3 that interest rates went up, the balance sheet dropped by 2.09. Therefore, our swap value must increase by 2.09 for the offset. So we wanted to do quite the opposite to our balance sheet. So in order to do this, we need to obviously look at the price sensitivity of the swap. But at this stage, we don't actually know the size of the swap. We know the size of our balance sheet, but we need to know how many swap contracts we need to enter to ensure that we have enough price change from the swap transaction to offset the change in equity on our balance sheet. So if we're looking at how much the equity changes, should be the reverse of what the swap value changes, we can have the formula on one hand. On the left hand side, we have the bank's balance sheet formula from week 3. On the right hand side, we have the duration of the swap formula we've just seen. If we look to rearrange this formula, well, obviously the percentage change element on both sides can be removed. They counter each other out. And then what we have left, we can rearrange to work out the notation value of the swap is the balance sheet over the swap. But remember, this is all about the value and the price sensitivity of how much the balance sheet changes divided by how much the swap changes. So now having this formula, we can suppose the same information that we used at the end of lecture 3, where we had the duration gap of the balance sheet, and then we're going to look at the duration gap of the swap. Now, as I mentioned before, the duration of the asset, okay, it's a 10-year bond, but because we're assuming there must be some coupon payments, therefore the duration is actually only 7 years because we take into account the cash flows. Therefore, the gap on the swap is of course 6 years. So we need to look at the size of the balance sheet, take into account price sensitivity from modified duration, and divide that by 6 years. And this works out that the overall swap contract we need to enter will value 38,333,333. And if your typical swap contract is £100,000, then essentially we need off balance sheet to enter into 384 contracts of this fixed for floating vanilla swap. Now obviously, given the size of the balance sheet, i.e. being 100,000 in this case, essentially off balance sheet we need just over a third, well, the equivalent of a third of our balance sheet in hedging contracts. So you can imagine this is quite an expensive thing to do if you're looking to hedge your whole balance sheet. So just to summarise what actually took place here, if we think prior to the hedge, on the left hand side of this table, our balance sheet was exposed because we had a positive duration gap. So if interest rates go up, our balance sheet goes down. Our balance sheet, we didn't have anything. Then during the hedge, to start with, we're still exposed to interest rate changes impacting the value of our balance sheet. But off balance sheet, we entered into a fixed for floating contract, and we had a 10-year fixed and a 1-year float. Obviously the duration of the fixed being 7 years when we take into account the coupon payments, and the duration of the floating just being 1 year. So then we simulated if interest rates rise by 1%. On the left hand side you can see the example from week 3's lecture where the economic value of the balance sheet dropped, and that dropped on balance sheet. But then off balance sheet you can see how the value of our swap transactions, all 38 million of them, the value of that increased by 2.09 million. Therefore, we immunised and hedged our balance sheet overall. But obviously, think of the inherent risks we've faced. Obviously, entering to a contract of this size and magnitude is a very large off-balance sheet transaction given the size of the balance sheet. We took a snapshot of our balance sheet at one point in time, and we also thought, or at least simulated, an interest rate rise. Well, what happens if interest rates stay the same? Or what happens if interest rates actually go down instead? Well, you're probably thinking, if interest rates go down, then the balance sheet will potentially result in more equity capital, but the swap would potentially lose. Now, remember the part 2 of this lecture when I discussed how the balance sheet might react to an interest rate change if you had a negative duration gap. We said that, of course, your longer dated liabilities will potentially drop more than your asset side from a duration point of view. So if your liabilities fall quicker than your assets, then this might result in regulatory capital increasing a little bit. But the likelihood, given the complexity of the balance sheet and interest rates dropping, overall market sentiment will result in asset and liability prices dropping quicker than what they would do if interest rates were to rise. So do think of all the inherent risks involved in doing this macro hedge. And this concludes this section of the lecture. Hi there, and welcome to the final part of this lecture on interest rate risk management for banking risk 2. In this part, we're going to go through the role of the Asset and Liability Management Committee and give an example of one of the challenges it may have when simulating a balance sheet and trying to maintain a commercial profit. So the role of the Asset and Liability Management Committee is obviously set out in the Principles of Interest Rate Risk Management from BIS in 2016 is to really provide oversight and set the risk appetite regarding interest rates, as well as other things such as liquidity risk that we will go on to cover in this module. But the role of the Asset and Liability Management Committee has grown in significance over the number of years. Predominantly the focus was on credit risk and market risk, but really the likes of interest rate risk and liquidity risk have become more dominant and a key player in risk following the financial crisis. So the Asset and Liability Management Committee really has grown in its importance within banking institutions. And it's really their role to set the risk appetite and maintain the mixture of assets and liabilities on the balance sheet, whether that be fixed or floating. And obviously taking into account the off-balance sheet items that can be potentially used to hedge the balance sheet. From my past experience working in the financial sector, as a mortgage broker, it was interesting to see, and you could tell when banks needed to potentially bolster up their assets base, because they would come to the market, specifically the mortgage market, with some really attractive, kind of market-beating products to potentially entice customers. But as a mortgage broker, you could see how quickly them products were snapped up by customers, and then the product was literally ended or ceased and just withdrawn from the market. But you could tell at certain points kind of waves of banks either putting up their mortgage rates so they didn't really get new customers, or when they started lowering them to be market beating to get additional customers. So you could see obviously this kind of, obviously it's part competition, but it's also potentially to get new assets on the balance sheet, or potentially reduce the amount of assets on your balance sheet by not making attractive products. So you can see this from an outsider when you look at the likes of the mortgage products they offer on the asset side. Of course, this will be reflected as well if banks had an attractive customer deposit rate or new savings product, then that might be included or put out there just to try and entice new customers to kind of bolster up the liability side. So you can see this from a consumer point of view if you're looking, and it has to be observed over a longer period of time. But ultimately, the role of the Asset and Liability Committee is also to simulate the balance sheet, potentially assess what is going to be the net interest income, what's the profitability, but then what is the market-to-market valuations of the balance sheet if interest rates change. So not only do they have to look at the mix of the balance sheet, potentially change assets and liabilities, but they also have to simulate the whole balance sheet change given any interest rate change. So if you think about what are the key rules of any asset and liability management committee, now if you go to any bank's annual report, there will be within the risk section a detailed description of the risk appetite, and it might outline the role of their own asset and liability management committee. Now it might not be called ALM, they may call it something else, but ultimately it is that jurisdiction. So the main objectives typically, now this list is not exclusive of course, but they're meant to look at the stabilisation of profitability, net interest income. They're obviously working on behalf of their shareholders and potentially want to maximise shareholder wealth. So again, that's looking at the economic value side. So taking into account both repricing and maturity model. Then ultimately they need to manage the gaps. This might be predominantly done on the preferred method of the duration model by the BIS. So they have to potentially look at the various gaps, the size of the gap as well as the signage, and obviously ensure that at any given change in value in the balance sheet that they do meet regulatory capital requirements and that the equity capital doesn't get hit if interest rates change. And let's not forget that they're also involved in the trading book on off-balance sheet when designing derivatives, hedging strategies for hedging the balance sheet exposure. So they will play a role in the trading book as well off balance sheet. Typically, for interest rate risk management, this committee tends not to use value at risk. It's not widely used that often on balance sheet exposures. Typically, it is to manage market and credit risk on the trading book. So typically, value at risk is not really used when looking at the whole balance sheet. It is really the role of the Asset and Liability Management Committee to look at the funding model, the maturity model, and the preferred model of duration to ensure that the gaps are set up to take advantage of where the interest rates may go, or potentially look at the size of the gap, because if the gaps are potentially large, in the case of a large positive duration gap, interest rates go up, the capital requirements or regulatory capital will shrink a lot if it's a positive duration model gap. Typically, this committee is headed up by the CEO of the firm, but that's not always the case. And as I've mentioned, following the interest rate risk in the banking book 2016 document, which outlined the 9 principles for the bank plus the 3 other or the regulators, first one was to set the risk appetite, but ultimately the whole length of that cycle, developing models, making sure the models work, assessing the models, then stress testing the models, then potentially looking at hedging strategies from the outcome of the models. All that whole cycle is really the job of the Asset and Liability Management Committee, and they will report upwards to the board of the firm. So let's look at an example of one simulation the likes of the Asset and Liability Management Committee can do, given a complex balance sheet and also trying to maintain profitable balance sheet from a commercial point of view. So typically, the purpose of this simulation, whether that's over 2 to 3 years, it could be another time horizon, the purpose of this is to obviously look at the exposure in any sort of likelihood. What's going to happen to net interest income? What's going to happen to the market-to-market value of the balance sheet? But also, the likes of this stress testing, it demonstrates a level of compliance with the regulatory requirements. Now let's have a look at the simulation process. So obviously, at the start of the process, you need to set the goal or the target of doing the simulation. So what is the purpose of the simulation? What variable are we going to look at? Are we more interested in what's going to happen to net interest income? Are we going to look at economic value instead? Or are we going to combine both in the simulation? We have to potentially say what is the interest rate now and what scenario is likely to happen. So if the banks have a position on where they think interest rates are going, they're probably going to simulate that change and see what happens to profit margins and economic value. As well as this, they're also going to potentially simulate the hedging strategy they intend to use and see how the hedging strategy would also work given the scenarios that they're about to stress test. And then ultimately, from this stress test, they will potentially have a look to see what the eventual outcome was there any unforeseen consequences to the hedging strategy, and potentially work out how they may improve either the structure of the balance sheet given the simulation or improve the off-balance sheet hedge. Given this example, we have a simple balance sheet, and the balance sheet's broken down into rate-sensitive assets and insensitive assets, but also rate-sensitive liabilities and insensitive liabilities. In other words, we have a split between fixed and variable, both on the asset and liability side. And you can see the size of the balance sheet there. Obviously, with assets being 36 and liabilities being 24, then that does mean gap between them is 12. And what the committee want to simulate is scenarios where, one, interest rates stay the same, and in this example, the interest rate is 8%. But then we're also going to potentially look at scenario number 2, where interest rates rise to 11%, so a 3% increase. So let's have a look at the mathematics so we can get a kind of sense of what the balance sheet looks like. So to start with, when we said 36 minus 24 is 12, now you're probably thinking, yeah, that's obviously asset balance sheet has to balance, that's regulatory capital, so 12 is regulatory capital. Okay, but in this scenario, we're just going to say that this is the liquidity gap. So this is kind of the shortfall in funding. In other words, we need 12 more to service our assets because we have more assets than liabilities from a balance sheet perspective. If we look at the funding model, where we look at the rate-sensitive assets minus the rate-sensitive liabilities, you can see that that is positive at plus 8. And then if we look at this from the funding gap minus the liability gap, then we have a variable interest rate gap of minus 4. And this is quite evident if you look at the number of rate-sensitive assets on the balance sheet. It's very high compared to the likes of rate-sensitive liabilities on the liability side. And it's also more than actual rate-insensitive liabilities on the balance sheet. But overall, what you can see from this is that we have a liquidity funding gap, the funding shortfall of 12, and that the interest rate gap of minus 4. So we've projected the gaps. Now let's scenario plan the commercial margin or profitability of the current setup in the balance sheet. So we're assuming that on our assets we receive 3% and our liabilities minus 3. So if we look at the current market rate, which we said was 8% when we have a scenario 1 of stable rates, therefore because we have a plus 3 margin, therefore our return on our assets, we return 11%, and on the liabilities it is 5%. So the commercial margin before the funding costs of the balance sheet is calculated below. We have the total assets times by 11, and then we minus off the total liabilities times 5%. So to start with, the commercial margin works out to be 2.76. But we need to then assess what is the accounting margin rather than the commercial margin. So within the accounting margin, we need to take into account the 12, which was your liquidity gap. And the liquidity gap needs to be timed by the current market rate. So what we have is the commercial rate, take away the liquidity gap times the current market rate. So overall accounting margin would end up being 1.8. Obviously here we have assumed that the liquidity gap of 12, to plug that, we would require to potentially issue liabilities at the current market rate of 8%. So now, if we look to simulate this overall, we can see in column A, the volume of our balance sheet. In column B, we can see the original rate. So we had obviously 12% on our assets, 5% on our liabilities. So column C works out the total cost in the case of liabilities and the total revenue in the case of assets. And at the bottom there, highlighted, you can see our net interest margin, which we just calculated, the accounting margin of 1.8. In column D, this is the scenario where we have increased interest rates by 3%. So obviously the rate insensitive assets and liabilities, the income does not change, but the interest does change on the rate sensitive assets and liabilities. So again, if we do the revenue and costings in the same procedure, then you can see that our commercial margin actually goes up. However, when we do the accounting margin or the net interest margin, we have to take into account the liquidity gap of 12 times at the new higher market rate. Therefore, taking that into account, then our net interest margin actually drops to 1.68. Thus, the simulation of interest rates rising from a profitability point of view hit our net interest margin, taking into account rate-sensitive assets and rate-sensitive liabilities, but also fixed products and our funding gap. Please take time to revisit this scenario and go through the steps in your own time and do the calculations to understand what we have done and where the numbers have arisen from. And this concludes this lecture, as well as theme 1 in Banking Risk 2. Your part of your directed study for this week is really to investigate the role of the Asset and Liability Management Committee for a bank of your choice. Potentially look through their annual report and their Pillar 3 disclosure report to see what derivatives they use and why they potentially use them. And you can see the various suggested readings which relate to this week's lecture. Thank you for watching.